Alright everyone, welcome to today's video. I hope you all are doing well and staying blessed. If you guys are new here, my name is Jeremiah and I'm a small cap day trader. In today's video, I will be reviewing the 10 lessons that I learned from my one trade a day challenge in the month of February of 2026. This was a really slow month. If you guys traded, you know that there was not a lot moving on a lot of the days. If we had something, it was all right. It wasn't super. Even the A quality setups really didn't work that well. So this is a month where you had to be disciplined, you had to be patient, and there's a lot of lessons to be learned from this month for sure. So with that being said, let's jump right into this slideshow I've made for you guys here. I'll also leave a link to this PDF or slideshow down below. So here are the 10 lessons from the one trade a day challenge in a cold market. The first one is position sizing. This one changed my trading. This can be the difference between winning and losing. If your position sizing is the same across the board, you won't really be able to see if your strategy is working or not. So let's say we have two stocks, right? Both $5, but one stock has a range of 10 cents. It's proved it can move 10 cents up and down. The next has a range of 50 cents. So you're not going to have the same position size, even though they're the same price, and even maybe they're the same float too. But one has proved it can move much more than the other one. So you're going to have to use that 1/5 share size on the one with a 10-cent range. You're going to have to use 1/5 of your position sizing on the 50 cents range stock. That's just that, because once you start to just use the same position size across the board, it's like you'll have maybe some small winners, but then once you catch a loser on one of these higher range stocks, then you've given back all of your profit from before. So I realized that initially this challenge started off as a one trade a day challenge with one share. And as soon as I saw something moving with a much bigger range, I was like, I wouldn't be risking the same amount on this as the ones from before. My winners from before were like 5 cents, 10 cents, but it was only on one share. But then I'm like, okay, I'm trading this stock. It's still lower price, but the range on it is about 50 cents. So if I lose 50 cents, that's 3 days of progress. So I had to figure out what I could do. And it actually ended up being 1/5 share size that evened it out. So if I can get 10 cents on a stock with a 10-cent range, that's fine. If I can get 50 cents on one share on another stock, that's the same thing. To find a range on a stock, you can use the ATR indicator, also known as the average true range indicator, or I personally just take a sample of past price action and then see how big each candle is moving up or down. I'll just hover over each candle and see, okay, this one's 50 cents. Here, I'll give you guys an example really quickly. So if we're looking at BATL here, I want to be looking at the 1 minute chart because I'm usually trading on the 1 minute chart. And that's what I'm basing my stop loss off of. So we're looking at 30 cents move here, and then a 20 cents drop there, then another 22-cent drop here. This is probably where you could have stopped trading, and that doesn't look good. But if we're looking at this doesn't look good, but 16 cents. But this one, you would say, you're like, okay, it doesn't have a range of 50 cents, but 20 cents either way. Most likely going to go with 5 shares because then I can get $1 a share, but my max loss would also be $1 a share. And then the upside potential may be a little more if you get a good candle like this. So 20 cents for this one. You really want to look at the bigger red candles. Those are the ones that, like, okay, if I lose the most I could possibly lose, it'll be around 20 cents. Worst comes to worst. So you can also ignore this. This original like drop here. This big okay, actually that's on the 5 minute, but you can ignore this. Like, this is a 50-cent drop. After this was like one front side of the move, and then once it started to curl back up here, this is another front side of the move. So as the MACD went positive here, this is sort of a new front side of the move. And then you want to base your stop loss off of this, not this. You're not going to look here and be like, oh, I'm going to lose 52 cents on this. But in any case, you're just going to focus on the most recent price action. So if you're looking here, seeing this move up was 19 cents, this move down was 16 cents. So 15, 20 cents, just say 20 cents for the sake of round numbers. But that's how you can calculate the range or how much you are standing to risk. So the next lesson I learned was that history repeats itself. This is so true in the stock market. You guys all know this. It seems pretty obvious, but you really have to think about it, like actively be thinking about it when you're trading, because if you're not, you're just gonna jump in something and you might not notice a previous shooting star jackknife, and you might just get caught in when you're like, dang, like, oh wait, it did it before. I shouldn't have even taken that trade. You'll save yourself from a lot of bad trades if you just take a few seconds to look at previous price action. This is another instance of where we see history repeating itself in the stock market. If you look at previous price action intraday, but also other time frames, the candles you see from before are the same candles you will see in the future. A lot of topping tails, flushes, false breakouts, and or jackknives. You can expect to see more of those. That's probably not going to be the last time you'll see that. And the flip side is also true. Clean price action, clean pullbacks, breakouts, long body green candles. You'll probably see more of that. So we know the stock market can be unpredictable, so just take this with a grain of salt. You got to pay attention to other indicators. You have to read level 2. I mean, you don't have to, but it's going to help you a lot to be reading level 2, reading time and sales. This will help you get an understanding of, is this really going to break out, or does this setup just look good and like there's a bunch of sellers on the level 2, you know? So it'll save you from false breakouts and whatever. And then the next lesson, this is super important. This is also another instance or another lesson that changed my trading. Tracking your metrics. If you're not doing this already, I would highly advise you to just try. If you haven't tried it, just try. Not all of the setups that work in a hot market will work in a cold market. This is another thing that seems really obvious, but us humans don't seem to act on it. You really have to make the conscious decision to not take certain setups. And I think the best way you can do that is by tracking your metrics to see which setups are working, in this cold market. So what I think I'm going to do actually is I'm going to have two spreadsheets. I'm going to have one spreadsheet for a cold market and then one for a hot market, because it's like night and day, the difference between a cold market and a hot market. There's a lot of the setups that worked before in the hot market will not work here in the cold market. More so than being aware of the fact that you have to adapt your strategy to the cold market, you have to know exactly which types of stocks and setups you will not trade. Find it helpful to track my metrics in an Excel sheet so I know which setups are constantly losing and therefore which ones I should avoid. Without tracking my metrics, I find myself trading from muscle memory and taking the same hot market setups that don't really work in a cold market. That is so true. Okay, next lesson. Less is more. You do not have to trade every day. Be okay with no trade days. The more you focus on quality, the better your trades are going to be and the more money you're going to make. It's a skill in and of itself, just trading the right stocks. And it's even more of a skill to be trading the right stocks at the right time and trading the right setups on those stocks at the right time. Because certain setups, like we said before, will not work in a cold market that worked in a hot market. As we now know, the terms right setup and right stock are completely dependent on the current market conditions. Different market conditions call for different setups and different stock types. So as you notice a shift in the market, it may be a good idea to make stricter criteria for what you will allow yourself to trade. Trade the best and leave the rest. That's a quote I live by. All right, so our next lesson is breakout or bailout. It's always important to be quick about cutting your losers, but especially in a cold market. If you bought expecting a breakout and it's already stalling out, you probably need to sell. The same goes for if it popped up originally and then flipped red. One of my red days during the one trade a day challenge, I got caught in two flushes in a row. Both of them were false breakouts, and I could have made them much smaller if I'd been quicker to sell as soon as they flipped red. I will say it happened very quickly, but if I wanted to bail sooner, I easily could have. This also goes back to my previous point about stocks repeating what they've already done. Getting caught in one flush should have been enough for me to say I'm done trading this stock. If you're curious, this stock was SPAI, and I will not be trading it as long as I remember how I traded it previously. Which brings me nicely to my next point, that some stocks do not trade cleanly. Certain stocks, despite fitting all of the criteria for my stock selection, just don't seem to trade cleanly. To prevent myself from trading stocks like this, I have written down stocks in a do not trade list on my phone to remember which stocks were difficult to trade in the past. Another thing that can help is having your trade history on your daily chart. This allows you to see whether you've won or lost on a stock before while you're looking at the daily chart or marking out resistance and support lines. This right here is an example you can see on SPAI, very choppy on the 10-second chart. Got caught in 2 flushes in a row. This is the stock I got caught in 2 flushes on. Just having order history here. When I look back on it, if I see this stock in the future, I'll look back here and I'll see it if I don't see it on my do not trade list, or if I don't look at my do not trade list. Next lesson is base hits add up. It's especially important in a cold market to book quick profits since we don't usually see follow through. If you were buying and holding before, you're now looking for quick scalps. That means you're buying and selling quickly, regardless of whether you're red or green. If you decide not to scalp trade, you will have to be a little more patient to wait for better setups where you can buy and hold for a bit longer or add as the stock moves higher. Here's my little example that I got from ChatGPT. Steady profits, and then wild swings. So if you're swinging for the fences, especially in a cold market, you're probably going to get smoked. This is not a shot at swing traders. This is just for momentum traders. If you're swing traders, I'm sure you can make money. Do not overlook the spreads. Bigger spreads can mean bigger winners, but the same is true for losers. Before jumping into a stock, look at the spreads and see where you'd be getting out if you bailed. If you have spreads bigger than 3 cents, you might want to wait for some more liquidity to come in. This mostly refers to stocks that have just popped up and not stocks that have had tight spreads before, but they are now starting to open up as the stock is pulling away. It's also helpful to look further than the best bid and ask. If the next order down is 10 cents lower on the bid, then you can assume if somebody decides to sell their shares to that highest bidder, it's going to drop 10 more cents after that. So if you're in that, you realize that, okay, I need to either get out now or get out before somebody sells to that bidder. This also goes for the ask. So if you're going long, that means there's more profit potential if you see, okay, we're at 550 now. Next level is 560. Next level is 580, then $6. So only a few orders till we get to 6. Okay, so it goes both ways, but just paying attention to the level 2 and seeing where orders are and how much profit potential there is and whether the risk outweighs the reward or the other way around. Our next lesson is identify and use key levels to your advantage. You will be able to set yourself up for much lower risk entries if you know where the key levels are. This is so true. In my trading during this month, taking entries around key levels has helped me get those entries where it just pops up immediately, and even if it didn't work, I could sell immediately because I was buying right at the key level. So whether it's VWAP, half dollar, whole dollar, daily level, EMA, trendline, or any level where buyers seem to be stepping in, taking an entry around these levels can allow you to take a low risk, high reward trade. But you should allow the stock to prove that it can hold that level before taking an entry. Keep in mind that just because it bounced off a level, it does not mean it's holding that level. I've lost money thinking that a stock is holding a certain level just because it bounced off. So the stock bounces off that level and I buy here. It hasn't proved it can hold that level yet. And then flush. And I just take a big loser. Anyways, I digress. Trying to take a bounce off these levels can be risky, especially in a cold market, because the stock could just keep going lower. However, in a hotter market with good timing and level 2 and tape reading, the bounce off these levels can be a very good setup. Our next lesson is trade the front side of the move. In a cold market, trade the front side of the move, or don't trade it at all. I would especially advise beginner traders to only trade the front side of the move. This right here, this is what you want to be trading. Obviously, sometimes you don't know if this is going to happen if you get in on like a micro pullback, but you can see it running into a daily level here. So you could have also sort of predicted that in that way. Once MACD crosses negative, you know it's for sure the backside of the move. Um, this doesn't mean that you can't trade it later, but it would have to curl back up and you'd want to see it back above VWAP, and that's technically a new front side of the move. So once you get to the back side of the move, it starts to get a little more risky, and you have a higher chance of getting a false breakout. This is especially true in a colder market. I would even advise not touching the stock after the front side of the move, like I said. This is obviously with that exception. If it curls up to new highs, then you can trade it, because in a colder market, once bears see any type of weakness, they're going to be quick to go short on that stock, and it's going to be a lot harder to see nice breakouts and things like that that us long traders want to see. So that's our next lesson. Is a choppy 10-second chart is a red flag. This is a bonus slide. I wasn't going to add it. This is technically the 11th informational slide. But if you're just pulling up a stock and you think the price action looks clean on the 1 minute, take a look at the 10-second chart, and that gives you insight to how the price action was inside of those 1 minute charts. If it's choppy on the 10-second chart, that may be a sign. That may just be a sign for you to leave it alone. You look here, you see these topping tails, these big wicks, and then huge flush, huge flush. I got caught in both of them. It's going to be harder to predict with a choppier 10-second chart. So just be wary of stocks with choppy 10-second charts. Don't undermine this chart here. This is very important. Anyways, that's it for today's video. I hope you all enjoyed and found this helpful. If you guys did, please leave a like and subscribe. And with that, I will see you all in the next one. Peace.